Hey everyone, so I think there's something really important in the interview between William Green and Guy Spier that happened just recently. I don't want anyone to miss out on this. So I've got through, I pinpointed the exact thing that I wanted to speak about today. I'll show that in a moment. And like I've listened to this interview twice already. Please do yourself a favor and watch it. Richer, Wiser, Happier podcast. I think it's We Study Billionaires is the channel. It's William Green interviewing Guy Spier, and it happened like a few weeks ago. And it's just do yourself a favor, check it out. And it's episode 23. That's what it is. Okay, so let me show you the clip.
Yeah, so the checklist item is an interesting riff on something that Warren Buffett has said. So we all know that Warren has said that he does not, he would not mind if the stock market was closed for 10 years. His valuation and his confidence in the value of the business is not reinforced by any particular price action or any particular quote. He looks to the results of the business. What are revenues? How much cash is it generating? What are owner earnings? All of those good things. But what I realized when looking at some of these companies that were investing in the future of their business, not from operating earnings, but from money raised in the market, either through equity offerings or through debt offerings. And many of these companies had originated inside of venture capital firms. And so the simple checklist item that comes up is, can the company fund all of its growth and all of its discretionary investment in potential new businesses from existing cash flows?
So I think this checklist item that Guy Spier is just talking about, a new one for a checklist, if you've got one, I think is really awesome. So only the best businesses can actually do this. So if the capital markets, I'm sort of merging these two ideas together. So if the capital markets were to close for 10 years, so you couldn't get any outside funding for nothing, for anything, like nothing at all. No banks, no stock market, no VC firms, nothing. Like you couldn't get any money from anybody else. You couldn't issue any stock. If all those things were taken away, could the business still fuel their growth? If it's a yes, that is one of their best businesses. Now you're going to say, okay, but a young business needs that fuel to get themselves going so they can reach that point of inflection where their cash flow starts to be enough that they can go out and continue their growth just from their cash flow. And I understand, yes, to a certain point, that is correct. But there are still some very small cap companies out there that have got to this inflection point and they really won't need to go out and raise any more money or issue any more stock or probably not even use too much debt anymore. And a really good example of this company is a company that's been flying along recently, fueled by a lot of this growth, but they've just hit this inflection point, is SDI Group. Please look at my previous video and my interview with Mike Creedon on this, but this is a really good example of a small cap company that I think has just got to this point. Yes, they're going to use some debt still because they can and they can get it at reasonable rates, but they actually wouldn't need to. Okay, now I need to be critical of myself here. Recently, I've become a little bit more tolerant of debt than I used to be. A few years ago, I was really against debt, especially in my personal life. Like I don't have any personal debt at all, and I actually don't think I've ever had any. I despise debt as it limits my options. For example, if I got a mortgage or something like that, I have to keep generating cash flow to pay off my mortgage. Otherwise, I feel like, you know, all of this stress in paying off this mortgage and my options are limited. What if I wanted to take 6 months off and like live in the jungles of Bali or something like that? Or travel the world and maybe, I don't know, go off and do something and not have to work or something like that. And that's where debt can become a burden, and I don't like debt for that reason, and I was always against it, but it's crept into my investing and I want to kind of stamp that back out again. So I guess I might have been twisted by the stock market and the amazing growth that exists in certain pockets of the stock market. So unfortunately, I have allowed debt to creep into my portfolio, not personal debt, but some of the companies that I have invested in do have significant debt. I think it's manageable debt, but it actually wouldn't be manageable if a handful of things went against them. They kind of need the debt. And that's a problem I see. This wouldn't check this item off Guy Spier's list anymore. And what I mean is, like, for example, accessing debt right now might still be okay, but it is getting more expensive, and it is still on the table. But if something serious happens and banks and the debt markets get like super fearful for a few years, let's say, and well, is the business that I'm invested in, are they going to have any issues? So not only do I have to ask myself the question, is debt fueling their growth? I have to ask, is the debt necessary at the moment just to run the business? And actually, interesting enough, when I do look at my portfolio and I start questioning my portfolio on this new metric, Alibaba might actually be a fantastic investment, far better than everyone thinks right now, and especially far better than the stock market thinks right now. It has this enormous pile of cash. It has no debt and no need for debt and no need for issuing stock. If the stock market and the capital markets were closed for a decade, Alibaba would be fine. They produce just bucket loads of cash and they don't have any debt. But some of my other investments, even though at the time I was making them, I thought were better, far superior investments to, say, Alibaba. That was my initial thought. But thinking about it a little bit more, they could get into trouble if something really dramatic happened in the credit markets, in the capital market space. So like if access to money became really tough. CSAM Health is a good example here. I'm going to back them in to be okay, but they have this big debt obligation because they have these bonds that they issued a few years ago. They're going to fall due next year, and things really have to go quite well for them. Otherwise, they're going to get into some trouble. Now, to counteract that, I do know the quality of the businesses that they own are like the most reliable businesses you could get. Software built inside of like long contracts in hospitals, in like private and government hospitals in Norway. That's almost impossible to rip those things out. So I feel very good about the businesses that they own, so that's fine. But this is no fortress of a business. They have this big debt obligation coming up, and things have to kind of fall into place for that to be okay. So to summarize all that, I want to get back to this idea. Very, very manageable debt and no need to raise money or issuing stock at all to grow. Growth, I think, must come internally. Now, for those of you who are new to investing out there, you're going to need a broker to make investments in public companies, and I use Interactive Brokers. I think it is by far the best and safest out there. It's got very low fees as well to access a lot of the international markets, like companies in Sweden and Hong Kong and England and all that type of good, all those good places, Australia as well. There's a link in the description if you want to take it for Interactive Brokers for a test spin. You can get a demo account and see how the platform feels, make some trades, see how you feel with some fake money before you use real money. That's, I think, the best way to get started anyway, especially if you're new. So yeah, link in the description. Hope you've enjoyed this video, and I will see you in the next one.